I'm Yahoo Finance Executive Editor Brian Sazzi, and you're taking a look at a live shot of the opening bells on Wall Street on this Thursday morning. A little rainy in New York City. Guests of the South Korean government ringing the bell at the New York Stock Exchange. Kodiak AI getting things popping over there at the NASDAQ. Indeed, a little bit of everything so far this morning, friends. Some strong economic data, much to the dismay of the rate cut-seeking bulls, but some negative news out of corporate America in Starbucks announcing its latest round of layoffs. You never want to hear that from Starbucks. Let's head down to the NASDAQ and check in with Yahoo Finance senior reporter Brooke DePalma. See what's hot in the markets this morning. Brooke, I reminded you yesterday to bring your umbrella. I hope you got one today because it's legit raining outside.
I did bring my umbrella this morning, Brian, and I'm glad that I did because it was drizzling just a bit. More rain expected in the forecast. But let's talk about what we're expecting to see here at the NASDAQ this morning. We are expecting to see the third day of losses. Stock futures now opening lower, down about 0.6% when it comes to the Dow. And this is according to the Yahoo Finance website. We do have the Dow down about 0.3%, rather. The NASDAQ opening a bit lower, down almost 1% as we make our way into today. And the S&P 500 also moving lower, down about 0.6%. And this is largely after we got the stronger than expected strength within the U.S. economy. Jobless claims came in less than expected. U.S. GDP grew more than economists had expected, largely led by fewer imports from April to June, as well as robust consumer spending during that time. And so now we are seeing all three major indices, though, open in the red, what is expected to be the third straight day of losses after we saw 3 days of record highs, as you can see right there. And what's really leading this downward momentum is perhaps some fear that the Fed is going to lower interest rates, or rather ease their cycle of lowering interest rates. Right now, there's about an 85% chance that we will see another quarter point cut at the meeting in October. And that was down from roughly more than 90% of markets pricing in that expectations that we would cut by a quarter point. But I do want to take a closer look at the 10-year T-note yield. That is rising higher, up about 3 basis points, as once again, there is this expectation that the Fed will sort of ease here and not jump into rate cuts as much as maybe we had previously expected. The 30-year T-bond yield also moving a bit higher, and the U.S. dollar also trending upwards, up about 0.3% at the open this morning, and up almost 1% in the last 5 days alone. But once again, taking a step back, we do see all three major indices moving lower as we make our way into this open, and we'll certainly be tracking it all day here for the NASDAQ.
A little bit of everything from Brooke this morning. Some stock analysis, a weather forecast, good stuff, Brooke. And of course, if you want some more weather analysis, download the Yahoo weather apps. The thing is great. All right, here's what I'm tracking right now, dissecting the data. With the market hearing a more subdued Fed chair the past week as it pertains to the economy, investors are on high alert for this to be reflected in the data. For if it's reflected in the data, it helps reinforce a case the market has decided to make on its own. Rate cuts will be the short-term new normal. Unfortunately for the bulls, this economic weakness wasn't reflected in GDP and jobless claims data today. Second quarter GDP rose 3.8%, while jobless claims came in less than expected. In AI fatigue, I'm keeping an eye on some profit taking that has emerged on AI names like NVIDIA and Alphabet this week as investors look for fresh catalysts. They certainly didn't get one from brokerage Redburn Atlantic this morning, which came out with a sell rating on the red-hot stock that is Oracle. The analyst here thinks Oracle stock could tank about 43%. Bold call. I'm kind of digging it. Starbucks still trying to brew up a turnaround. Coffee giant said this morning will lay off 900 people in a $1 billion restructuring plan. The company will also close 100 stores, or about 1% of its store base. None of this should come as a surprise to investors. Here's what CEO Brian Niccol told me on Yahoo Finance in July.
Yes, there's a list of challenges that we have to take care of, but they're all things that are very much in our control. And I think if we stay focused on those key areas, we'll continue to make great progress. We've made progress on transactions. We've made progress in our value perceptions. We've made progress on mobile order, and we're going to continue to do that.
All right, here in the opening bid at Roundtable, Brent Schutte, Northwestern Mutual Wealth Management Company CIO, alongside Yahoo Finance senior reporters Brooke DePalma and Inez Ferre. I'm going to flip the script a little bit. I want to go into Starbucks. We just heard from Brian Niccol, really talking about his restructuring plan. When we talked with him last, Brooke, in July after earnings, this is the company still, I think, going through a restructuring plan, to say the very least.
Yeah, absolutely. Since we spoke to him back in July, September 9th did mark 1 year since Brian Niccol officially took the helm of Starbucks. And we continue to see, though, the stock under pressure. Year to date, it's certainly moving lower, roughly flat after this news. But what we know is that this last quarter was the sixth straight quarter of same-store sales decline for here in the U.S. Now, this closure of stores, even though it's 1%, the last quarter was roughly about 18,800 stores. This will take us now to about 18,300. And so really they're sort of trying to pick and choose where exactly they want to invest. Where they want to invest is creating that coffee house culture. They want more people staffed up. They want partners, what they call employees, in the locations working more hours. And they really want to create this energy, this culture, this vibe that consumers want to turn back to. And that's something that they haven't been able to pull forward since he joined the helm. Once again, the stock's still under pressure because momentum, the tide hasn't yet turned. We're waiting for that turning point, and perhaps this could be a step forward towards that.
And as I'm inclined to take this as a Starbucks specific story, and the company is still trying to get its sea legs under it, relaunch new items, get its store base correct. Not necessarily indictment that the economy is falling off a cliff, because we didn't see that in GDP this morning.
No, that's right. We didn't see it in GDP, and consumer spending is still strong. Look, this definitely seems to be a bit of a Starbucks story because it's a brand that has been around for so long that it's not evolved perhaps the way that it should have with all the competition that has been going on in the space. They have so many challenges. They've got the inflation challenge. They've got the labor challenge. They've got the higher competition. So this trend now that they are leaning into of making it a cozier place, a place that people will actively want to seek out to go to, because you also have the remote work and the hybrid work and that entire consumer also trend to contend with as well, or challenge, I should say, for places like Starbucks. There's a lot of competition out there, and they need to go back to that focus of, why do I want to go to Starbucks? Well, not for the dark lighting and the dark furniture. You have to have something better to go to Starbucks too, and that's what they're leaning into, that experience.
And as absurd as this may sound, what I'm about to say is I've been going to Starbucks because they've been putting "Have a fabulous day," or actually "Have a great day" on my extra large Trenta cup. And Brent, that has me excited. You know, I like going to a store and they're going to put smiley faces on my mug. I dig that. What's your read on the consumer here as we're going into the back half of the year? Because as goes the consumer, as goes the economy.
So I think this is more of an economic-wide issue. I don't know about Starbucks in particular, but what you're seeing is an overall economy that's still growing, but heavily bifurcated. So what's kind of kept us going is that AI theme, that AI spending, and the higher income consumer. At the same point, you have a low hiring but low firing kind of backdrop on the labor market. And so this is the worry on the growth side. These companies are all starting to see margin squeeze. You're thinking about tariffs increasing their cost, but with little ability to pass that along. And that's where I think the fear is with many at the Federal Reserve and other people in the economy, that actually as that margin squeeze occurs, as you can't pass those input prices along, that you actually have to let go of labor. And that's where I think there's a delicate balance right now that is underneath the surface, not completely visible from the top, but certainly there. And that's where I think the market, where I tie this to the economy, is similarly bifurcated. It's been driven by a narrow segment, and that creates a delicate balance.
And as Brent just mentioned all things AI, I was talking about AI fatigue coming into here, seeing some weakness in NVIDIA. Barclays out with an interesting note this morning on AI and how big that industry is going. And I think you were on a call listening to their thesis a little bit more.
Yeah, I was on a call just now listening to them comparing the AI boom to the dot-com bubble and why it's not necessarily like the dot-com bubble. First of all, because the spenders during the dot-com bubble were the telecom companies. They were comparing CapEx to sales. They're saying that right now it's increased 25%. Back then it was up 40%. They're also saying that the telecoms were depending heavily on debt in the credit markets, not not is the case with the hyperscalers that are flush with cash. And they're also talking about how hyperscalers are a high margin business and that their operating companies are, their operating expenses, I should say, are going up, but the revenue is going up at a faster pace. So Barclays is actually saying that they see a strong footing for the AI theme. They don't see a derailment, so to speak, for the next 6 to 18 months. Yes, there are risks. Yes, they are. They also talked about euphoria in the markets. Euphoria in the stock market right now is elevated. We all know that. But as far as the overall AI theme, when it comes to the hyperscalers, they say that it's on strong footing.
Brent, real quick, final word to you. Do you buy the dips on AI names?
Look, I think that likely Barclays is not correct. I think there are echoes of the .com era. It doesn't mean they're exactly the same. I think the risk is that people have priced it as if Barclays is correct, and that's where I would encourage people to own things outside of just AI. And so don't focus only on AI stocks, because that is where there is the risk that it doesn't turn out the way that people imagine right now, which is already priced into the market, which is at the same levels roughly on many measures as it was back in late 1999. I would focus instead on cheaper parts of the market, because I do think valuation works longer term. I do think history repeats, and I do think you'll see better days ahead for the average stock in the S&P 500, as well as small and mid cap in the U.S., which trade at relative valuations at the exact same levels as 1999, which ushered in good years ahead for those parts of the market. And that's where I would continue to focus on people being diversified and not concentrated.
I am feeling that hot take. That's the hot take I needed on this Thursday morning. Big thanks to my opening bid roundtable, Brent Schutte, Brooke DePalma, and Inez Frey. All right, coming up, I sit down with Charles Schwab CEO Rick Wurster to get his perspective on the market melt-up we have seen. We'll be right back. Charles Schwab is eyeing a big push into the crypto space in early 2026. This as it contends with stock prices at record highs and a new generation of investors looking to get into the action. Caught up with Charles Schwab CEO Rick Wurster for today's opening bid power player segment.
Well, our clients are really engaged. They're trading at about 30% more than they were last year. We see margin balances up. We see more use of options. Our investors are really engaged in the market. And I think there's a variety of things driving the market higher, including some of the big tech names that now make up a fair amount of the index.
Almost all of them, it seems like.
Well, their fundamentals have been so strong. The cash flows are there, and there's real robustness to their businesses. So I think that's been fueling the market higher, and our clients love it. I've spent the last couple of weeks going to about 15 of our branches, and I would describe our clients as happy because their balances have never been higher, but a little bit nervous about the elevation of the market.
Where are they inclined? Are they starting to pull money out of the market? When I hear nervous, I'm thinking, all right, maybe some profit taking coming up.
You know, often they come into our office or they call in and ask that question. Should I get out of the market right now? The markets, my wealth is beyond where I thought it would be. Markets are beyond where I thought they'd be this year. Should we get out? And the point we always make to clients is it's about time in the market as opposed to timing the market. The hard part about timing the market is you've got to be right twice. You've got to get out at the right time, and then you've got to be able to get back in at the right time, and that's very hard to do.
Do you get a sense that your clients have missed a lot of this rally?
I don't get that sense at all. Our clients have been invested. They've been invested in equities, and their balances are at an all-time high.
Meaning they're chasing performance, I think is what I was...
Oh, are they chasing performance? I think that actually in a lot of ways, retail investors have led the markets this year. They were the ones buying at the low in April. And people were pointing at retail investors saying, oh gosh, retail investors are making a mistake, but we're 30% higher than we were back then. And credit to the retail investor. I think they've been on a right about a lot of things over the past few years.
Yes, they have. I mean, Yahoo Finance is the home for the retail investor. We see the excitement on our platform. Rick, how has the retail investor changed this year? I think when people say retail investor, it's the uneducated person who's trading stocks in someone's basement. That's not the retail investor I've interacted with.
I couldn't agree more with you, Brian. Our retail investors, they're engaged in the market. They're engaged in research and education. I'm sure you see it on your platform in terms of the views. We spend about 35 hours a week providing coaching on how to become an investor, how to trade. And that's being consumed at record levels. The other thing we see from retail investors this year is more demand for advice. More and more clients are wanting help in their financial life, and so we're providing it to them. The other thing that's come up more recently that we're seeing from retail investors is a renewed interest in fixed income.
Really?
Yeah, believe it or not, bonds
The
are
retail investor wants
cool again.
fixed income.
Yeah, well, what's happened is with money fund yields coming down, investors are asking, hey, should we be in a bond strategy that has a little bit more duration to it so that we don't run into this reinvestment risk issue? So we are seeing bonds be of more interest to investors.
I have to ask Liz Ann Saunders more about bonds.
Yeah, ask Liz Ann.
She is always on. I don't ask her enough about bonds. What are you telling them, though? How do they invest in bonds?
Well, there's lots of ways to get invested in bonds, and we do tell them now is a reasonable time to think about moving from a money fund to a bond-oriented fund, and they can invest directly in bonds on our platform. They can buy an ETF. We have managed accounts where we can customize a bond portfolio to their needs. So investors are finding plenty of ways on our platform to be invested in bonds, but it's nice to see the interest.
It's a rare interest.
Yeah.
How do you anticipate, since the last time we talked, we now have a rate cut from the Federal Reserve. How do you think what looks to be a series of rate cuts on tap, how will that impact a platform like a Charles Schwab, but even more broadly, how does it impact the world of investing?
Well, number one, when I think about what happens with rates, I think about what is that going to do for the economy and what's it going to do for markets. Historically, rates coming down have generally been beneficial for markets. You get a lower discount rate, you get a less restrictive Fed, money goes into assets. And so I think all else being equal, I would expect in a lowering interest rate cycle in an economy that's still pretty robust for that to be supportive of markets. And I think that's in part why you're seeing markets continue to hit the highs that we're seeing and clients are enjoying. So it's probably the biggest impact. It's just what it means for clients on our business. For us, we perform well in a variety of interest rate environments. Our earnings have accelerated. We'll have an all-time record high, first half of the year in terms of earnings. And so for our business, we're going to do well in either environment.
It's good to hear that clients are asking for human advice, but that's not necessarily the case. A lot of companies in financial services have leaned into robo-advising, robo-advice. Is that a place you have to play in?
Well, we believe we want to meet a client where they are. And that means we engage with clients digitally. We've had record numbers of digital logins, about 500 million a quarter, which is a record. We have lots of clients who want to engage with us digitally 80% of the time for their day-to-day money movements and stock purchases. But once a year, they want to know, where am I relative to my plan? How am I doing? Or there's a big issue, a life event that they face. A grandchild or child's buying a house and they want to help, or unfortunately a spouse passes away. In those moments, they love to be able to walk into one of our 400 retail centers, sit across the table from a person, and have a conversation about what that means for their financial life. And one of the things I love about what we do for retail investors is we don't make them make a choice. If you want to talk to someone, you want a human interaction, we're here for you. If you want to invest digitally, we're here for you. And what I find with most of our customers, they want a little bit of both. It's not digital or in person, it's both.
Last time we talked, you sounded like you were working on some things on the crypto front. Any update on Charles Schwab and what it will be doing and won't be doing on crypto?
Well, crypto's become a big part of the investing conversation, and I certainly hear it when I'm out talking to clients. What are we doing in crypto? How are we going to help them? Number one, we want to provide support and education about what crypto is, why it may make sense for an investor, what its role may be in a portfolio. So we want to provide education so people know what they're investing in. Number two, we have lots of ways that clients are investing in crypto today. And our clients actually hold 20% of all the crypto ETF assets in our country. So they are invested in crypto. In addition to that, we'll be launching spot crypto in the first half of next year. So
it's big for Charles Schwab.
That'll be a big move. And what excites me about that is we have lots of clients who forever have been Schwab clients, but they took a little money and they brought it over to Coinbase or they brought it over to somewhere else because they had to They had to because we didn't have it. And we're excited that that money is likely to come back to Schwab and be part of the broader relationship. So we're excited about that.
Does that increase the risk on a Charles Schwab balance sheet?
It does not, because these are client securities. It's on their balance sheet, not on our balance sheet. There used to be a rule for companies that were banks, which is that you needed to hold capital against client crypto positions. And that's why the banks, including Schwab, who we have a bank, haven't been in crypto directly yet. But that rule's changed, and now folks like ourselves and I think there's other bank-related companies that have made announcements to the same effect that they're going to come out with crypto, direct spot crypto as well.
What's the game plan to take market share away from a Coinbase and Robinhood, where you go to these platforms, great in their own right, but they've captured that younger generation consumer?
Well, I want to differentiate, if it's okay, Brian, between the younger investor and the crypto investor. I do think some of these digital native firms have a lot of crypto-oriented investors on their platform, and certainly some long-term Schwab clients that wanted to own crypto that went there. Our plan for capturing market share is to bring those clients back that love us, love the in-person interaction, love the digital interactions, have 98% of their wealth with us, and want to see their crypto with them. So I think that'll be a nice win for us. But I also want to talk about the young investor, because I think sometimes it's a misperception about our role with young investors. We've brought in 1 in 6 of our new to firm clients this year is under the age of 24. We are winning with the young investor. We're on TikTok, Instagram. We're the most followed financial services company on YouTube.
Wow.
We're in all these places, and we are winning the young investor. And what I love about that is that when they come to Schwab, they get access to all our research and education. They get access to 1,000 traders who are former professional traders who wake up every day ready to answer the phone to help any new investor become an active trader, a long-term investor. They are there for them. So I love the fact that we're doing so well with the young investors, and that we can bring education, support, and the industry's best platform to help them meet their investing needs.
I love hearing that. Those are, I didn't know those stats. Those are very interesting. Lastly, when I knew you were coming in, I'm like, I have to ask Rick about this, because I can't think of a better CEO to ask. Quarterly earnings. You've heard the debate with quarterly earnings. President Trump wants to go to semi-annual. What say you? Is semi-annual good?
I have, as CEO in my role, the good fortune of our 2 co-chairmen were the 2 former CEOs, and they were CEOs for 49 of the 50 years of our company's existence.
No pressure following them.
Well, there's pressure following them, but one of the great things about it is both of them take a long-term orientation. We've always managed Schwab with a long-term outlook about how do we do right by the client. And if we make the right decisions for clients, ultimately that will lead to good economics for our shareholders. I think there's value in having that long-term orientation. And so to the extent there's changes made that move other companies toward a longer-term orientation, that's probably net good for the economy. That all said, I think that there's still going to be a demand from shareholders, owners, analysts for regular communication. We put out a report every month with all of our client activity. How much net new assets did we see?
I feast on that thing.
Yeah, how much trading there was. So we believe in transparency, regular transparency, combined with a long-term orientation. So regardless of what happens with how frequently you're reporting earnings, I think we're very much aligned with the concept of a focus on the long term, but keeping people informed.
I'll grab a drink here or there with CEO of a public company. They're like, every day I'm trying to make my earnings number. I mean, do you feel pressure like that?
Absolutely not, and that's a blessing of having Walt and Chuck, who've got a long-term view on the business. I think in our business, we only succeed if we deliver for our clients. And so every day we're making decisions about how do we do right by the clients. The very first time I met with Chuck Schwab, I went in there with a presentation and he asked me a bunch of questions about our fees. And I thought he was going to ask me, hey, we're underpriced in this area. Why don't we get fees up because we'll make more money and the stock will go up? And he said, Rick, we got to cut these fees down. We got to create a better deal for clients. And I said, well, Chuck, our earnings won't grow. He said, yes, they will. People will do more business with us. That long-term orientation is what has underpinned our success, and that's not going to change.
Good point by Rick there. Think about the long term. Digging that. Coming up, Julie Hyman has you covered on Market Catalyst, and I'll hop back onto the set For a chat with Rubrik founder and CEO Bipul Sinha, shares of the cybersecurity play are up a sizzling 22% year to date.